Hi, and welcome once again to the video series explaining how to use the Sea Grant Integrated Financial Model for Kelp Aquaculture. My name is Tammy Warner, and this is coming towards the end of our series of videos in which we are going to be talking about some economic analysis over here in the enterprise budget. So at this point, we've gone through how to complete all of these sheets with user inputs, which are indicated in red. So you have learned how to identify and describe what your business model is, how to evaluate and list out all your costs for starting up a nursery operation and a farming operation. And then we've talked about how to estimate your operating expenses, and then defining what you're bringing into the business as a beginning balance sheet and where you're going to get the money to pay for it all in the funding sheet. In the last video, we talked about these three standard financial reports projections: the cash flow projections, the pro forma or projected P&L, profit and loss or income statement, and then the projected balance sheet. And we talked about the relationship of these three financial reports to each other and to the inputs that you put in the red sheets. In particular, we talked about how your estimates for ongoing cash flow needs show up in the balance sheet and flow through. Now we're going to get into some analysis, right? So what we talked about before was really reporting on the results of the inputs. Over here in the enterprise budget and corresponding analyses pages is really when we start getting into the sort of implications of decisions that you might make, right? So an enterprise budget is an economic analysis tool. It is a little bit different from these financial output sheets because it breaks up your cost structure a little bit differently so that you can glean a little bit more information. So let's go ahead and take a look at that enterprise budget. Okay, here we are over on the enterprise budget page. And you'll notice that this is empty because this is the budget for a standalone nursery operation. And we're not doing a standalone nursery operation. We're going to do an integrated nursery and kelp farming operation. Okay, so to get this to populate, you go over to your business model page and you create a business model that is a standalone farm operations by selecting none for the nursery. Okay, so now, the rest of the model is all not going to work at this point. This isn't, you'd have to go in reality, you'd have to go into your revenue models and into all your startup costs and all that and change it. But this enterprise budget will work for demonstration purposes by just selecting none for your nursery model. Okay, so we're going back to the enterprise budget. Right, so now we have a standalone kelp farm, and we're getting 59 cents a pound on average for our kelp. We are growing 64,000 pounds of kelp. That gives us $37,000 in revenue. Okay. Here are all the variable costs associated just with the grow out operations. If we include our owner's labor in the variable cost, that gives us a 21 cents per pound of kelp. If we leave out the owner's labor, it's 12 cents per pound. And so subtracting the variable costs from the revenue, that gives you this contribution margin with and without owner's labor included. Okay, so we have $29,000 in contribution to give to contribute to overhead, but our total fixed costs are $30,000 the way that we've got this thing set up now, so we're not breaking even. We are making a little bit of a loss. Okay, so we're selling $64,000 or 64,000 units, pounds of kelp, and we're making a little bit of a loss. And this will not show up in the profit and loss as it's set up now because we've got a model here that doesn't match what we're analyzing. Okay, so I'm just going through this as an educational exercise for any of you that do want to do a standalone farm operation. Okay. With this cost structure then, how much do I need to sell? How many units do I need to sell? How many pounds do I need to sell in order to cover my costs? Right, so right now, I've got an average price of 59 cents. If I want to cover my costs, including owner's labor, then I'd have to charge 69 cents. If I don't want to cover the cost of my labor, then I'd have to charge 60 cents. Okay, so if we just let's just test this. Okay, let's test this. Let's put, instead of having this calculated value, okay, I'm going to do something to the model just to show you how break-even works, right? I change this to 69 cents. Now, and then I change, so if I change this to 69 cents, and I change this, which is currently pointing to some information from the proformas, if I change this to calculate as 69 cents times 64,000, right now I've got revenue of 44,000 and I've got a profit now of 5,900, which should just about match what we're implying is the cost of owner's labor, or the opportunity cost of the owner's time. Okay. If I change this to 60 cents a pound, without the owner's labor, that's our break even. This value down here, the pre-tax returns, should be right around 0. So let's try that. So there it is, pretty close to 0. Okay. So that's what break-even is. It looks at what is the effect, what price do you have to charge? Okay. If we are operating at our actual, expected price of 59 cents a pound, how many do I have to sell? How many pounds do I have to sell in order to break even? So that's what a break-even analysis is. This is a very, base level differential analysis that business owners can use to make operational decisions. Okay. Now, that is pretty straightforward for a standalone farm operation. Quite straightforward. Let's change this model back then to our actual model, which is an integrated operation. So we're going to have a small nursery and medium farm. So now we come to the enterprise budget for our actual operation that we have populated this model with. And this is an integrated kelp nursery and grow operation. And so we conduct the same kind of enterprise budget or contribution margin analysis that we did above, breaking out the fixed and variable costs, and having all variable costs for the entire operation here, which including owner's labor totals, in our case, 21,000. Without owner's labor, it totals 12,000, etc. All of the fixed costs that we evaluated. Here's the thing, though. We had to make an assumption that for a farmer that also has a nursery operation, the primary focus of that farmer's thought process would be the kelp farm, growing out the kelp. And so we have broken out all of these cost elements per pound of kelp. And basically we're looking at the sale of the seed string as kind of gravy, right? So that $25,000 of extra revenue is not really part of this enterprise budget analysis. As before, right, we are coming up with the same number for our profit as we did using the profit and loss statement, but we're looking at all these cost elements as a portion of the cost per pound of kelp that we produce. And so our total variable costs, given the cost structure that we have, are quite low here, right? It's only 20 cents per pound of kelp without the owner's labor, 33 cents with it, which gives us a nice contribution margin, again, if we're just looking at the value per pound of kelp, because our returns here include the revenue that we're getting from the seed string. Right, so this analysis, if you want to apply this thought process to an integrated operation, it's a little bit, it's not exactly parallel to the way that you use these to think about the standalone aspects of the operation. What you do see, though, is that the total costs, fixed costs plus variable costs, for the entire operation are 70 cents per pound of kelp, right, which we know is higher than the price. Right, so in a sense, the way that we've got this model set up, the nursery sales, the sales of seed, is basically compensating for the fact that we aren't covering our costs with the kelp yet. And again, the inputs into this model are just, they're not anything approaching right. I'm just describing how you can kind of use these analyses to think through. Because of the sale of the seeds, we do have a profit, but we're selling our kelp below cost. Okay. The other thing, because there are multiple products here, a break-even analysis, as we did in the prior sections, is not relevant here. It's not possible to do. So that is what's on the enterprise budget page. Now we're going to move on to the next aspect of an economic analysis of this model by doing what's called sensitivity analysis. And let's take and look at the sensitivity analysis for a standalone nursery operation. What we're going to find, because of the sort of reality of the integrated operation, a sensitivity analysis is also not going to be able to be as meaningful for an integrated operation, but we do have much better tools for doing what-if analysis with our integrated operation. But let's just go ahead and create a standalone nursery business model so we can show you how the sensitivity analysis works. So let's see, we're going to take and make our farm model none, and that will populate our sensitivity for a standalone nursery. Okay, so each of these tables, we're selling 100,000 feet of string at 25 cents a foot. Here's our variable cost, which we picked up from the enterprise budget. Here's our fixed cost total, fixed cost per unit, total cost per unit, right? So, okay, we are getting $25,000 in revenue. Our total cost is $20,000. We have a pre-tax profit of $4,800 and a break-even price of 20 cents. And by the way, total cost is 20 cents, break-even price is 20 cents. That's how it works. Break-even price gets you zero profit. Okay, we need to sell 75,000 units of this stuff in order to be able to break even. Okay, so that's what how the break-even analysis ties into a sensitivity analysis. Sensitivity analysis is basically a way of looking at how important parameters change with changes in inputs. All right, so here we have our pre-tax profit right here, $48.58 just from the nursery operation. Okay, that's this. Here's our pre-tax profit. Here's our total cost up here, 20 cents. That's from here, right? Here's our total cost. Here is our price, 25 cents. That comes from here. Okay. Now, if we take and change the price by 10%, right? So here I'm just multiplying this 25 cents times 1.1, multiplying the 28 cents times 1.1, right? So if I grow the price by 10% and shrink it by 10%, if we grow the cost by 10%, shrink it by 10%, right? What happens to our profit? Okay, so these calculations, you don't need to get into the details of them, but we see that if the price goes down to 20 cents and if the cost is up to 22 cents, by George, we're losing money, right? This is a negative profit. So on the inside of these tables is the profit. On the outside of the tables are the moving variables. Okay, we did this for changes in price and total cost, changes in price and variable cost, and then changes, let's see, break-even price. So what happens to my break-even price if I change my fixed cost and my variable cost? And what happens to my break-even sales volume, or feet, to changes in variable cost and fixed cost? So that is a sensitivity analysis. And again, because of the nature of this model and the nature of the integrated nursery and grow out model, we really can't do this exact type of sensitivity analysis with the integrated model. But we have something even better. So that's going to be the topic of the next and final video. Sensitivity analyses are great, and they allow you to move two variables and see how one output changes. But if you wanted to change more than two variables, you have to do something better called scenario analysis. So that's what we're going to be looking at in the final video, and I'm going to show you how to do scenario analysis for this model using Excel's what if tools. Okay, so that's where we're at. One more left.